We just heard on the last panel from allocators about the overall market environment, interest rates, banking crisis, and now we're going to hear about things from a different vantage point and dig into the role that alternatives play in portfolios and investment opportunities and considerations that allocators need to keep in mind. So let's dive right into introductions. And Sona, why don't we start with you?
Sure. Great to be here, everyone. My name is Sona Menon. I'm a partner at Cambridge Associates. We serve as an investment advisor and an outsourced CIO to institutions such as endowments, foundations, pensions, healthcare institutions.
Alex.
Hi, I'm Alex Band. I'm the CIO at Partners Capital. We're an outsourced investment office, and really it means we focus on three things. One, we manage customized portfolios on behalf of a great set of endowments, foundations, family offices. Two, we invest on their behalf globally across all the major public and private asset classes. And three, we really build enduring partnerships with great asset managers.
And so this panel, we're talking about outsourced CIO, and that's why I wanted to start with the two of you. So Sona, can you go into a little bit about the role of an outsourced CIO?
Yeah, absolutely. So we essentially serve as an outsourced investment office for organizations that say don't have the expertise or the resources to build and oversee their own investment portfolio. So that could range from institutions that have a few $100 million to a few $1 billion, where we essentially build their portfolio, we implement their portfolio, and we oversee their portfolio on their behalf. And that also actually comes in sort of multiple models. There's a fully delegated, rather discretionary model where you're essentially turning over the keys to the OCIO to make any changes, invest in managers, fire managers, implement the portfolio without coming back to the institution. And then there's a semi-delegated model that we employ whereby there is a little bit more connection back to the institution, but it's still more or less fully outsourced.
And Alex, you do things a little bit differently, right?
Yeah, we have very much the same business, but we are focused on the investing side and more on the discretionary portfolios where we really control and are accountable for the results of the investment portfolios. And
so Jens, let's go to you. Tell us a little bit about your role.
Yeah, good morning. Jens Foehrenbach. I'm the Chief Investment Officer at Man FRM. FRM is a fund of funds within Man Group. We manage 20 billion in assets for institutional clients. I'm also on the executive committee of Man. We have 140 billion approximately under management in alternative strategies, mostly on the liquid side, some real estate investments.
The world's largest publicly traded hedge fund, too.
I've been told.
Yeah. Not that people in this room don't already know that. And Paul, need no introduction, but give us a little one. Anyway.
Sure. Paul Zummo, I'm a CIO and co-founder of JP Morgan Alternative Asset Management. So we're managing $20 billion as well in hedge fund and private credit assets, have about 100 relationships, 100 manager relationships. So it's all external.
Yeah, so really dynamic, interesting panel. Obviously, I want to kick things off at the macro level and big picture. And so Sona, I mean, you manage across the board, right? For pension funds, endowments, foundations, also healthcare institutions. So talk to a little bit about how investors should be making changes in their portfolio right now.
Yeah, so first and foremost, we are building, as Alex said, long-term portfolios for these institutions. And so we have a strategic asset allocation that very much reflects the objectives that each institution wants. Endowments and foundations really want to focus on maximizing their risk-adjusted returns. Pensions, private pensions, the corporate pensions really have a more of a liability-driven approach where we're really trying to help them improve their funded status over time. So the strategies are unique and the portfolios are designed to reflect that. What are we doing right now? Well, if you think about the dislocation that happened in markets last year in 2022 with massive interest rate volatility, we've talked about that, and equities being down double digits, pension plans, the corporate pension plans, a lot of them actually saw their funded status improve because the rate vol really helped them. So what's been happening for us for the last 6 odd months is really we're helping some of these plans where the funded status has improved so much, we're helping them de-risk. So what that really means is we're moving away from some of their growth orientation and moving it into the hedging part of the portfolio. So that's something that's a part of the framework that continues to happen. For endowments and foundations, again, growth continues to be important. And given what happened last year, there was a dislocation in the markets. We're leaning into more, and I'm sure we'll talk a little bit about this, but we're leaning into more private credit. We're doing more private equity venture than ever, and I know we'll also talk about that, but just leaning into more opportunities for growth and changing the portfolio inside of each of the sleeves.
So taking a step further, I'd love to go into a little bit about the dichotomy between short-term and long-term opportunities and how you think about that in this environment right now.
Yeah, so I was rebalancing. I've been rebalancing the portfolio quite a bit. I'll give you an example. In trying to de-risk a pension plan, I have to essentially move out of the growth assets and move more into the hedging assets, and that varies by portfolio. But I'm having to essentially, in some cases, reduce allocation to hedge funds because they're semi-liquid, and unwind that part of the portfolio. I've been also very mindful of my equity, of my factor exposure, growth and value. Growth has really had a phenomenal few years, as we all know. Value actually came back a little bit last year, but on the short term, after there's been really strong runs on growth, I've been rebalancing back into value. I did a bunch of that early last year, thankfully, because growth had an atrocious year last year, and now it's sort of come back. So, we no crystal ball, we don't know where the markets are going, but I really try to understand what I own in each of the asset class sleeves that we have, and know how it might behave in a stress situation so that we're able to react fairly quickly once volatility does come.
And Alex, how are you seeing this investment environment?
Yeah, so for our portfolios, we mostly are working with endowments, foundations, family offices that are focused on long-term risk-adjusted returns. And so with that lens, we do think the environment has fundamentally changed in really two important ways. One is a lot of the tailwinds that we saw over the past 10 years, low inflation, low interest rates, fiscal stimulus, quantitative easing, et cetera, are stopping or reversing and are likely to be headwinds over the next 10 years. And the second is to what Sona's saying, the volatility environment has increased and dispersion has increased. So we think there'll be a real setting aside of winners and losers. And so the question for us is, how do we invest in that environment? And it's really one where we think market returns are likely to be more subdued, and so outperformance and alpha is even more important to driving the returns in your portfolio. And so when we look at that, we really stay focused on what are those true structural drivers that will get us those returns, and things like funding entrepreneurship and innovation where we think it's really working, helping grow and make companies more profitable that are good businesses, financing interesting opportunities, exploiting market inefficiencies. And so those are the areas as we look at the long term that we want to lean into those opportunities while we're managing the short-term risk and the short-term volatility.
So how has your investment portfolio changed as you're looking at all these factors?
Yeah, so some of the changes we've made is one, we do see a very interesting opportunity in privates across the board, and particularly in the private credit space, and we've been very active there. It's been an area where we've been investing for about 10 years, a little over 10 years, but it's really given us the opportunity to lean in now when the opportunity set has become very interesting. So that's one area. The second is on the lower risk liquid side, where we can really exploit the higher volatility environment, but do it in a way that's less dependent on the direction of markets and the market tailwind, which we think is much more uncertain.
Mm-hmm. And we'll go deeper into some of those topics as we get a little later. But Jens, staying on the macro level, we didn't really get into this too much on the intro, but you see things from the GP and the LP lens. And so looking at the landscape right now, what guidance are you imparting to managers?
So I think there's a pretty important long-term theme, and you're right. I have the perspective as an allocator, investing in hedge funds, and then I also work for hedge funds. So I'm trying to form a little bit the way how we approach the following issue. Clearly following the financial crisis due to QE, financial repression, alpha wasn't there as much as before anymore, I would argue. If you're a manager with a 2 Sharpe ratio, persistent 2 Sharpe ratio, none of this, what I'm saying, is now relevant. But of course, those are rare, and there are problems with it: capacity, liquidity. The fees may not be suitable for you. Does this mean that everyone else is irrelevant? Yeah, absolutely not. However, the commingled, the off-the-shelf product, right, may not be suitable to create enough value for the end investor, the asset owner, given the alpha that's available. So specifically to your question, what we've been trying to do within Man is to push the solutions idea, right? And of course, solutions, that's a popular term in the asset management industry. What I think is a bit unusual for us is that you have a multi-product hedge fund that has opened up this barrier, this product barrier, and we've been moving into the heavy customization to build something that's very specific to a problem that a client has, which means effectively that the alpha that you can harvest in the market is sufficient because you're much closer to whatever the client's portfolio requires.
Mm-hmm. There are a couple of other things that we had touched on when we were speaking to in terms of breaking down barriers, right? Can you talk a little bit about that? I thought that was really interesting.
Yeah, sure. I mean, the barriers may pertain to an investment problem, or a specific factor risk, but there are of course others, such as fees, right? What type of what fees are you willing to bear? What capital efficiency you need? The question of liquid and illiquids, right? It doesn't seem to be the most efficient way to separate them, right? Why not trying to find a solution where you harvest the alpha that you find on the liquid side, but then you combine it with a liquid solution.
Mm-hmm. And you were also talking about transparency. So how does that factor in more now?
I would say it's just another dimension, right? Another dimension that we need to solve for clients. Again, the transparency of funds that create very high Sharpe ratios may not be what you require, what you need to deliver to your trustees. So it's another dimension that we can solve. Obviously, managed accounts are an important topic for my firm.
Yeah. So you also mentioned liquid alts, which is huge for Man Group. Talk to us a little bit about that and how liquid alts should play into the role in an alternatives portfolio.
So we obviously all know that the value of diversification in portfolios, and we all know that some parts of the portfolio have to be liquid. I think what has been forgotten a little bit in the last 10 years or so for obvious reasons. I mentioned QE and the impact that has had on our behavior, on how investors reacted to this, is this intersection between diversification and liquidity. So, if I look at the portfolios of our institutional clients, clearly the dominant risk is equity risk, and I'd argue often there's too much equity risk in the portfolio. Historically, hedge funds would fulfill the role of being the liquid alternative. So, finding strategies that are really truly orthogonal to equity risk, to growth risk is one part of the equation. And then let's talk about the liquidity. So I think the first problem is that in an environment of quantitative tightening, quarterly or monthly liquidity do not fulfill the role or the function that you need for a liquid diversifier anymore. And the second development is, of course, that we've seen hedge funds moving away from monthly and quarterly liquidity if they can and tighten these liquidity terms. Really strong example of that, why this topic is relevant was, of course, in the UK last year when in September we saw a pension crisis with interest rates moving massively, which resulted in funds being forced to sell assets at stress levels. Why do we care here about the UK? In the previous panel, Elizabeth mentioned the debt crisis and what that could do to portfolios, to pension portfolios, which are heavy in private. So, in summary, I'd say, of course, you shouldn't have all of your portfolio in liquid alts or liquid diversifiers, but notwithstanding their lower Sharpe ratio versus their liquid assets, I think some of it makes sense and has become more important given the macro environment.
And I'm curious, Paul, if you have a take on liquid alts from your vantage point too, with what you do at JP Morgan.
Yeah, so About $1.5 billion of the money we manage is actually liquid alternatives. So I do think it's important. It's a trade-off between, as you extend liquidity, you open up a wider opportunity of alternatives. But for many, it's really important. I think the trick is really trying to find the managers that can actually perform and pursue strategies that are orthogonal, as Jens mentioned, to really make a more interesting return stream. To diversify from traditional equities.
And you've been in this business 25 years, so I want to kind of go to the two of you, like on the liquid staying on liquid alts for a minute. Like, how has investing in that and the strategy for incorporating that into your portfolios kind of shifted over the last 5 to 10 years? So Jens, let's start back with you, and then I want to.
Yeah, I mean, it touches on what I said before. I think the main point is that there has been too much traditional risk premium and alternative risk premiums have creeped into portfolios. So not only, of course, the equity allocations, but also into what is supposed to be diversifier. And we've been working hard to push this back and really make sure that we find sources that are diversifying, which at times when volatility is low, comes of course with, as Paul mentioned, with a cost to portfolio. To the portfolio.
Yeah, I think like one of the important things, well, maybe just to set the stage, when we are pursuing liquid alternatives, we're not generally excited about like risk premium solutions. I mean, that's maybe a small part of what we're doing, but it's less interesting to us. So what we're really doing is hiring hedge fund managers as sub-advisors and kind of putting that into a liquid alternatives solution. I think the change from 5 years ago is just the breadth and in depth as well of the number of choices that we have. So in the structure, I mean, there's a couple different structures, but let's take the UCITS structure. We can only pay the managers a fixed fee. And as you can imagine, only so many managers kind of wanted to sign up for that. In the last, again, 3 to 5 years, I'd say the number of managers that are open-minded to that has expanded dramatically. And as importantly, again, going back to the orthogonal discussion, the types of strategies are much more interesting. So 5 years ago, as you might imagine, it's the long-short equities and event-driven oriented strategies, maybe, handful of credit. Today, it's much more interesting from the standpoint it's macro managers and it's relative value managers, which again are really important elements to create a diversified portfolio.
And so on a high level, I mean, you kind of jumped into this, my next question. I want to hear from you, Jens, too, on which strategies, it goes without saying, we're in this never-ending, volatile market cycle, recession, no recession. We can debate it till the cows come home. Everyone has a different answer. Everyone has a different percentage point. But what strategies are working for you at Man right now in terms of hedge funds? Yeah,
we'll see if it's never ending. It may actually be good for us, for our business, if it's never ending, but I doubt it. I mean, clearly, given what we're doing in...
Or it just feels never ending. Of course, the music's going to stop at some point.
Yeah, it's probably the next 2 weeks. It may definitely feel never ending. I mean, given what we're trying to do in our investors' portfolios, it is, as discussed, about diversification. Systematic strategies generally fit well into that. And of course, that's a large spectrum, but we combine those that have higher Sharpe ratios with those that have nice defensive characteristics, such as trend following.
Yeah, well, I mean, to your question, so if we are going to continue to be in a period of elevated volatility, like the strategy that I would call out as being one of the biggest beneficiaries of it is statistical arbitrage. So we've been overweight relative value, which is inclusive statistical arbitrage for a while, and we're moderating certain elements of that, but not necessarily statistical arbitrage. So. When I'm talking statistical arbitrage, I'm not speaking about more like the longer term time horizon factor-based, approaches. I'm really talking about, shorter term, think weeks, maybe a month kind of time horizon, both prior-based and machine learning-based, and generally not taking factor risk, or at least not structural factor risks. And those types of strategies are just natural beneficiaries of volatility. So they thrive in a period where volatility is elevated, not extreme. Obviously, don't really have any direct exposure to kind of economic risk as well. And then lastly, like the moat around the strategy, or the moat around the alpha, if you will, is much higher than in other strategies. It's obviously complicated, both from an allocation standpoint, but from a competitive standpoint as well, right? So when you see like, a strategy like merger arbitrage, which has effectively been arbitraged out over the years, much different, I would argue, in certain areas of quantitative investing. So yeah, it's an area that we continue to continue to find new talent, continue to build in portfolios.
Sticking on hedge funds, so Paul, what mistakes do you see institutional investors make when they're thinking about hedge funds in their asset allocation strategy?
That it should be 100% of their asset. No, I wouldn't say it's institutional investors. If anything, I would suggest perhaps that there are people that are advising the institutional investors that are looking at hedge funds in an incorrect way. And the reason, no one on the panel, but broadly speaking, and here's kind of what comes to mind. So if you look at hedge funds, the 8,000 or whatever number there is of hedge funds, the pairwise correlation of hedge funds is 0.2. It is not really an asset class. Like an asset class does not have a 0.2 pairwise correlation. And you can think about certain strategies, statistical arbitrage we spoke about, like broadly relative value, has nothing to do with the risk return and characteristics of something like long short equities, but it's all kind of lumped together. And it really just does a disservice to the industry, a disservice to people's portfolio. You really have to think of hedge funds as a collection of strategies that each of which have an ability to play a certain role, some of which are important, some of which maybe you don't want in an overall asset allocation. So that's first. The second thing is, and again, this is probably a little more debatable, but is just the notion of alpha and how you're thinking about alpha in an asset allocation framework, right? So obviously, traditionally, mean variance framework, people are gonna, either estimate or use backward-looking kind of returns and come up with, their asset allocation. And the problem is, if you're looking at like large cap equities, obviously 95% of what you're buying is beta, 5% is maybe alpha. In hedge funds, the equation is much, much different. And what traditionally people are doing is plugging in something for hedge funds that represents the whole industry. And what I would say today is the same thing I would have said 25 years ago, is you should not buy the hedge fund industry. Like, as a whole, it does not make sense. So if you're plugging that in, you're effectively saying, like, you're suggesting it's going to be something that you really don't probably want, which is why I think a lot of the asset allocation frameworks are going to minimize what you have in hedge funds. And because at the end of the day, like, it's a industry of skill. And if you're hiring me, whoever you're hiring, if you look at like the good players out there, they've added several hundred basis points of incremental alpha, over and above managers. So like, I would suggest if you're allocating to the space, you have to think about not just what the HFRR has done, you have to think about it in an alpha standpoint. And if you think that, either the people that you're giving the money to can't generate that alpha, you really shouldn't be there.
Right.
So yeah, I think alpha.
If I can jump in here. I mean, I completely agree with what Paul said, but how could it be different? He's a veteran allocator. The other big mistake that I've seen, and you'll sense a little bit of frustration here, is this notion of volatility being bad, right? And especially after 2008, it took a lot of discussions and time for us to convince our clients that you ought to have high or somewhat high volatility in your hedge fund allocation, because otherwise it doesn't matter. It's totally irrelevant for the portfolio.
Right.
Because we know you will not allocate 30%, 40% or whatever it is to your portfolio. So you need to think about what you get for what bang for the buck, right? And the buck here is the risk that you're taking. So you want to maximize the alpha, the risk. Maximize the risk over fees as well. And
I would just add to that, like on the volatility in a slightly different way. Like 25 years ago, we more or less had like one fund of funds, and and that was it. Today, 85% of our business is customized for clients.
Right.
Line item volatility for clients is really a challenge, right? So like when we're constructing a portfolio, let's say you have 15, 20 managers, like each manager is playing a certain role. They're not all expected to perform well at different points. Like, that's the point. And I feel like the discussion is always like, oh, this guy's, if he only didn't make these 3 terrible picks, we would have been up so much more. It's like, no, they're there to hedge. And So it's
It all fits into the puzzle.
Yeah,
it's challenging.
I think we're dying to jump in here. Bring us in.
The hot button question. I'm happy everybody wants to jump in. So Alex, I know you wanted to jump in here as well.
Yeah, no, it sounds like we all have a lot to say on this topic. I'd say volatility, I completely agree with what Jens and Paul are saying. The thing we really watch is correlation across the portfolio, because managing these different sources of return across strategies and accepting the volatility works when you truly feel like you have diversification and you have low correlation across the different ultimate underlying investments that you're making. And so within hedge funds, we are more and more focused on strategies where the market portion of the return is quite low and quite managed. The alpha portion is what you're paying for and what is significant. And that the correlation across them is manageable and low. So I'd say that's another thing that I would add on. Before I turn it to Sona, just one more, because there's so many fascinating topics in this area, and that is really on the talent side. We really don't over-focus on the fund structure and exactly how the investment is. I think the key is the strategy and the talent. You want to find talent that's going to have high long-term Sharpe ratios. It's less about either timing when you're in specific strategies or insisting on a certain structure in order to get that return.
And Sona,
I'll build on that a little bit. I'm in agreement, and I think we actually agree with you more than you might have thought, in the sense that hedge fund programs are not all alike, and I think one of the places where the mistakes have happened and where there's been some dissatisfaction over the last many years around just the hedge fund strategies, definitely not an asset class, I agree, is that it's about expectation management. It's like, why did you put them in your portfolio in the first place? There are multiple reasons you could put hedge funds in your portfolio. There are endowments and foundations that put hedge fund programs together because they just want a lower beta approach to more equity-oriented growth. So they have a lot of equity long short. They have stuff that sort of looks a little bit long only, but has lower beta to it. And they can withstand the downside, supposedly, and hopefully with that comes with it. But, when we build portfolios for, say, pension plans where we are much more aware of drawdown risk, I think about it in a far more diversified way, where, if I have definitely some of the growth component, but we also have a lot of the things that you're talking about. We want the macro, we want absolute return, we want trend following, et cetera. So the question then becomes sort of, how are you sizing those bets, and where are you leaning into? For pension plans, I lean much more into the defensive stuff, the stuff that's orthogonal as well. And you know that orthogonal stuff moves away from you more often than it moves towards you. But when it moves towards you, boy, that moves towards you. 2022 was a fantastic expression of that, where the systematic strategies and the global macro managers really saved the day for hedge funds, because long short, went down along with equity. So I guess pulling it all back, hedge fund programs have to be diversified. I think you need to think about what you want out of them and build a portfolio that sort of reflects that, whether you want a growth orientation or a sort of a defensive absolute return orientation. And really also, we didn't talk about this, but then benchmark it appropriately too, because if you're saying you want defense and then it's benchmarked to the S&P 500, then you're going to feel bad about it at some points in time.
Can I add one more point to this?
Yes. Yeah. Okay.
So I agree with you. To be comfortable to say that you push down the risk pedal, so to say, right? That you lean into risk in hedge funds. You do need to solve the correlation problem.
Yeah.
And the approach that we've been taking is forget about correlation, because they're so unstable, they don't work. So we really look at how do hedge funds behave in the tails? Do they have concurrent tails? So, don't worry about the body of the distribution, just look at the tails. Yeah. And if they do behave similar in tails, then they share a risk budget together. So you're not reliant on whatever correlation assumption you have. But I do agree, of course, the drawdown topic is the Achilles heel of the question of risk.
So we only have a couple minutes left, but I want to ask one more quick question. If we do, there's always lightning round at the end, but I want to make sure we hit this one question on hedge funds before we shift over to privates and close out. Long short has been such a disappointing strategy for some time. How are you guys? What are your current thoughts on long short as a strategy?
Well, I mean, I have focused a little bit less on long short just because more of my institutions are pensions. And so I would say, maybe a third of long short exposure versus everything else where I have absolute return, like I said, trend following, macro, event driven, things like that. And so, because again, I didn't want the correlation, and I don't want if the beta that comes with it. If I want it, I'd get it in my public equities portfolio. That being said, there has been disappointment. We also tend to like specialist managers in the long short space, and some of them which have done really, really well, like tech-oriented managers, last year really gave it up, really gave it up big. So I think then it becomes a question of tolerance of time. If you measure performance over quarters and just 1 year, you're going to be more disappointed. But I think you kind of need to take a step back and say, did I expect them to do this in a year like 2022? And if you did, then you shouldn't be worried about it and sort of let it kind of come back.
So
I want to make sure, I want to shift gears, just make sure we get to privates really quickly since we're almost out of time. The private market landscape has totally shifted over the last 10 years. And so I'm curious as to how you, Alex, are thinking about the private markets right now.
Yeah, it has shifted, but we're very excited about the private investment opportunity right now. And I'd say across 3 different areas. First, in private credit, we think there's an incredible opportunity, and it's likely to be a 2 to 3 year opportunity that we're going to see. And there's a lot of good businesses with balance sheets that are either inappropriate or unsustainable for them that are going to need to get refinanced, and that source of financing from banks, et cetera, is continuing to be withdrawn. So that'll provide one great source of opportunity. The second is in traditional private equity and buyouts, where it is a different story from what we've seen in the past 10 years. If you look at the last 10 years of returns for buyout industry as a whole, about half of the return has been from multiple expansion and from cheap leverage. That's unlikely to be the case in the next 10 years. So what's really important is managers that can drive revenue growth, can drive accretive acquisitions, can drive margin expansion. That's how they're going to be able to generate returns. And then the third area is actually in venture capital. We're still leaning into that area, and we're especially focused on the early stage right now and the opportunities that we're seeing in those areas. There's still great companies being founded. They still need to be funded. And while we're being a little bit more patient and cautious on the later stage piece, which hasn't fully repriced at this point in time. So we're actually leaning in on the private opportunity as a whole at this moment, but doing so in a way that reflects the current environment.
Jens, do you have any thoughts on the private credit space?
I mean, I agree with the narrative that Alex described. For us, we're focused more on the liquid side, but I think the economic environment throws off opportunities here as well. So one example that stays in the credit field right now is on the convertible arbitrage, where a lot of the portfolios are very credit sensitive, and we had seen issuance of companies that otherwise have no other debt outstanding, and there's equity buffer underneath. So those are interesting opportunities, not in private credit, but in liquid.
And Sona, we're talking about private credit in the green rooms, and you had a lot of thoughts on that. Really quickly, if you had,
Did you say private credit?
Yeah.
Yeah. We love private credit as well, and I agree with everything that's been said. And now, especially private credit, especially direct lending, is so interesting and exciting. And you're getting unlevered returns of up to 8-9%, and levered returns of 12-13%. Especially for pension plans, that's really attractive cash flow. Even if you're not a pension plan, for endowments and foundations, it's even competing with some private equity returns. So I think that private credit continues to be really interesting, particularly direct lending.
So to close out, I want to do a lightning round and get everyone's best investment idea, or more specifically, a contrarian investment idea. So Paul, let's start with you.
Contrarian ideas, it would be reinsurance retro. So a tremendous supply-demand dislocation in the space. No one's paying attention to it. Everybody's scared of it, which is great. So we think, well, I mean, you never know. It's just 1 year time horizon, but it's kind of modeling at like a 24% expected return this year in the space, in the piece of the market that we invest.
Awesome. Jens?
Contrarian idea is systematic credit. We've seen multi-strategy and large quant funds moving resources away from it because out of sample didn't look as good. It is a less efficient market, of course, than equities, far more complex, requires a lot of data experience. But if you can crack it, I think the alpha that you can harvest is very attractive.
Alex, I want to go to you next.
Okay. I wouldn't call this a contrarian idea, but the capital solutions opportunity within private credit and finding ways to provide capital and refinance good businesses that need it is an opportunity I think can generate 10, 15% unlevered returns going forward. We think that's really interesting. On the more contrarian side, we do like the biotech opportunity. That was one of the first areas to get hit with the repricing. It's repriced significantly. And companies with good science and good financing will end up being very valuable.
And Sona, I come to you last because you wanted to answer the question differently.
I do. We often get asked, what is the profile or characteristics of managers that you really like? What are you looking for in managers, particularly in the private space? And I would say that, the ideal profile, or there's not one particular profile, but characteristics we really like are managers who have a very focused strategy, so they have very focused talent that they're hiring, often specialist managers that have a very unique and differentiated source of ability to source, managers that have diverse talent and diverse perspectives. Sustainability focus is becoming increasingly important. We haven't talked about it, so it is going to be part of that, and really strong operational capabilities. These are some of the sort of key characteristics we're looking for in the managers that we invest in.
All right, so we're out of time. I think that's a good deal. You got 4 best ideas. You got the overall perspective from the markets, and thank you guys.